Hello, I'm Phillip Smith, financial planner with Tidepool Wealth Strategies, dedicated to helping late career professionals navigate the tides of retirement planning with clarity and confidence. This is your retirement planning guide to money management, pursuit of long-term financial growth, and creating an adaptive strategy tailored to your unique and evolving journey. In every episode, I'll share concise, actionable insights to help you plan a retirement of purpose, resilience, and confidence. Welcome to
The Perfect Retirement Plan?
Hi, welcome to this episode of The Perfect Retirement Plan. I was connected with a prospective client not too long ago who had changed jobs 4 times over the last 20 years, which is pretty normal. But here's the thing. Every time he switched jobs, he left his old 401k behind. He told me, I know it's there, but I haven't touched them or really thought about it. I looked into moving them a while back, but it seemed like it was going to be a lot of work. When I asked about the accounts, he pulled up some stuff on his phone and recalled balances from recent paper statements for the other accounts. Putting it all together, he'd left a trail of around $200,000 just sitting in previous employer accounts, neglected, unmanaged, and possibly costing him more, maybe in fees, but also in future headache than he had realized. If that sounds even remotely familiar, you're not alone. Right now in the US, there are over 29 million quote unquote forgotten 401k accounts, totaling nearly $1.7 trillion in retirement assets. And that's as of 2023. 2024 was a good year in the market, so I am sure that currently that total dollar amount is much higher today. That's a lot of people leaving a lot of money sitting around collecting dust. Maybe worse, being eaten away by high fees, subpar investment choices, or just suffering the neglect of not being included in a resilient, adaptive, long-term retirement plan.
So what you're saying is there are people out there just ghosting their own retirement savings, leaving it on red like an ex they don't want to deal with?
Pretty much. I'm not sure if all of the target audience will get that reference, but yeah. So today we're wading into a very common question that we get asked in my office. What do I do with my old 401k? And yes, this conversation applies to 403Bs and deferred comp or 457B retirement accounts as well. We're discussing 4 main options, what we call in the industry the FINRA 4, the pros and cons of each, and how to avoid the big mistakes that could cost you thousands. And hey, if this podcast has been helpful, hit subscribe and turn on notifications so you don't miss out on future episodes. Here's what we're covering today. We'll start with why so many people forget or ignore their old 401ks and 403Bs. Then we'll discuss the 4 options for handling yours and which one might be best for you. From there, we'll transition to the biggest mistakes to avoid, and then we'll wrap up with what action steps you can take today to try and get your retirement money back on track. By the end, you should have the knowledge to begin a clear strategy for dealing with any old 401ks you might have lingering in the background. Let's open with the scope of the problem. How many people out there have quote unquote lost retirement accounts? This is a massive issue. Over 29 million Americans have left behind a 401k, and those forgotten accounts hold close to $1.7 trillion of total retirement money as of 2023. Every year, 2.8 million new accounts, every year 2.8 million new 401k accounts are abandoned, meaning people leave an employer and don't take any action on their account. The average lost 401k balance is $55,000.
So let me get this straight. People are misplacing or sort of leaving behind the equivalent of a brand new SUV and just moving on with life?
Apparently, yeah. But instead of misplacing car keys, they're misplacing retirement accounts. To be fair, the money is more or less safe. But I've had conversations with people where they've said things like, I've lived in 5 different states. I've had retirement accounts in all of them. One company was in Florida 15 years ago, and they've since been bought out by another company, changed where the plan is at multiple times. I don't even get statements anymore. When you wait too long, what could have been 15 minutes to an hour of paperwork or online process to move the account can become multiple hours of just trying to figure out where your account is and how to get access to it. It's important to know how to solve this little dilemma. Let's talk about what to do if you have an old 401k sitting out there. There are, generally speaking, 4 options, though one of these doesn't apply if you're retiring. Option 1. Leave it with your former employer. Yes, you could just leave it where it is. It's the easiest because, well, you do nothing. For some people, this actually isn't a bad option, at least not in the near term. If your old employer's plan has great investment choices, low fees, if it's a smaller size company where you can actually talk to the financial advisor on the plan, leaving it alone might be fine. It's a good temporary solution. Be aware, though, that a balance under $7,000 can be forced out of the plan without your consent. Thinking of that means the majority of those 29 million accounts left behind are larger than $7,000. Also worth mentioning, depending on state law, 401ks generally offer stronger creditor protections than IRAs, which can be helpful if you're ever in a financial pinch.
So, you're saying that this is like staying on your parents' phone plan. Works great if it's cheap and reliable. But at some point, it's probably like, time to move on.
Yeah, time to be a grown-up. And here's a potential problem. You have no control over changes in fees or investment options. If your former employer decides to switch providers, introduce higher fees, or remove good investment choices, you won't have a say in it. Being someone who advises on employer-sponsored retirement plans, I honestly can't even imagine that happening. We're always looking to help plans reduce fees, and we help monitor the investments in the plan. But I suppose not every 401k plan is like that. And then tracking multiple 401ks, that's a recipe for a logistical mess. Why make life more complicated? For most people, consolidating accounts is a better move. So one form of consolidation is option 2, roll it over to a new employer's plan. If your new employer offers a 401k plan, you can roll over your old account into the new one. For someone who is retiring, this isn't actually an option. But for someone changing employers, this can be a great option if you want to keep everything in one place and simplify management. Plus, some employer plans have lower administrative fees and access to share classes with lower costs. Fees, service, access to the balance, these are all things that can vary from plan to plan. But, and it's a big one, not all plans accept rollovers. While I've never personally seen a plan that doesn't accept pre-tax rollover money, there are more plans than you'd think that don't accept Roth rollover money and don't allow for Roth contributions for that matter. Though, due to some recent regulation changes, that trend is shifting, and some plans have limited investment options or potentially higher fees than an IRA.
Basically, rolling into a new 401k could be an upgrade, but only if you're not trading filet mignon for a fast food burger.
That's a weird analogy, but yeah, it always comes back to food with you.
Food is diverse. It doesn't pass judgment, and it's necessary for survival. It can serve as an analogy for, well, pretty much most things in life.
You do you, buddy. So before we move to a second form of account consolidation, I want to be sure and cover an important disclosure that pertains to 401k type accounts. Actually, Cash, why don't you take this one?
Cool. Just lay that one on me. Okay, so before deciding whether to retain assets in a 401k or roll over to an IRA, an investor should be sure and consider various factors, including, but not limited to, investment options, fees and expenses, services, withdrawal penalties, protection from creditors and legal judgments, required minimum distributions, and possession of employer stock. Please view the investor alerts section of the FINRA website for additional information.
Thanks, sir. Another form of consolidation could be option 3. Go and roll over the balance to an IRA. Rolling into an IRA gives you the most control and flexibility. You get to choose the place where to set up. You get full control over the investments. You choose whether to work with a financial advisor and what that advisor relationship looks like. All of this gives you control over the fees you pay and gives you greater control over your money. Plus, if you're waiting to meet the eligibility requirements of a new employer's retirement plan, having an IRA may give you the ability to continue making retirement contributions. But with great power comes great responsibility. Unlike a 401k, where your employer sets up automatic contributions and investment menus, you have to manage an IRA yourself. Unless you're working with a financial advisor, then maybe you're paying them for management, planning, helping to hold you accountable, and maybe more.
So an IRA is like cooking at home instead of eating out. You know, you have more control, but if you don't know what you're doing, well, you might burn something.
The food strikes again. Yes, that's pretty much right. If you roll over to an IRA, work with a financial advisor to make sure you're saving, investing, and planning wisely. And now option 4, which I usually present in enrollment meetings as the worst option, cash it out. And I'll share why that's usually a mistake. You see, some people see their old 401k as an easy pile of cash and just cash it out. By some, I mean 41% of participants who leave an employer, according to a 2023 study detailed on the informs.org site. So some is actually a lot. It's a bad idea. If you're under 59 and a half, you'll get hit with the 10% early withdrawal penalty, plus income tax on the entire amount. And the federal tax withholding is set at a mandatory 20% when you take the distribution directly from a 401k, 403b, or 457b. So maybe that's enough, maybe it isn't, but you don't get a say in the matter. Here's an example. In Oregon, if you cash out $50,000, you could lose about $20,000 or so to taxes and penalties. 20% federal, 9% state, 10% penalty. We're at 39% just disappearing. And depending on your annual income, that may or may not be the right amount of federal tax paid, or state tax for that matter.
Man, cashing out your 401k is like setting your wallet on fire because you're cold. It's technically an option, but a friggin' terrible one.
That is correct.
The only time this might make sense is if you're in an extreme financial emergency. And even then, there are usually better alternatives. I don't want to get on my soapbox about compounding growth, but man, when you cash it out, it's not just the tax hit, it's the missed growth opportunity. Even if an account grew at a moderate 6% per year, which of course is not guaranteed, but hypothetically speaking, it would double about every 12 years. So cashing out $50,000 means pocketing maybe $30,000 today. But it also means not seeing that amount, without adding to it, potentially become $100,000 in 12 years, $200,000 in 24 years, or $400,000 of retirement money in 36 years. Now, just for giggles, or maybe remorseful groans, if you left $50,000 invested in an S&P 500 index fund over the past 12 years, ending December 31st, 2024, your account would have tripled. Past performance doesn't guarantee future results, so don't take this as an investment recommendation. It is not one. I'm just sharing some perspective on the missed opportunity that results from cashing in a retirement account. So, we've covered the scope of the problem with leaving behind old retirement accounts, and we've discussed the 4 options that every participant has when they leave an employer. I guess the only thing left for me to do is try and move you to action. So let's take some action on this. All right, here's what you need to do. Number 1, track down any old 401ks, 403bs, 457bs. If you're not sure where yours are, check the National Registry of Unclaimed Retirement Benefits or contact old employers. Number 2, compare your options. Decide if rolling into your new 401k or an IRA makes sense, or if leaving it alone is the best option. Number 3, if you're unsure, talk to a financial advisor. This is a big decision that could impact your retirement income for decades. How'd we do? I think this will be really helpful for quite a few people out there, like 29 million or so people out there. Or maybe it's just 10 to 15 million repeat offenders. Either way, I hope you found this helpful. Remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on. See you next time.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity.